The residential real estate market in the United States in 2026 is operating in a regime of compressed appreciation expectations and elevated financing costs that has fundamentally altered the calculus of property ownership. For the better part of the prior decade, a rising tide of broad-based price appreciation allowed owners to absorb a significant degree of value erosion attributable to property-specific factors, location disadvantages, functional obsolescence, deferred maintenance, because the macro tailwind was strong enough to carry most assets forward regardless of individual characteristics. That dynamic has shifted. In a market where annual appreciation in most metropolitan areas is measured in low single digits rather than double digits, the factors that quietly and systematically reduce a property's value relative to its comparables are no longer absorbed by the broader market. They compound. And for buyers and owners who fail to identify and account for them, the result is a resale position that is structurally weaker than the acquisition thesis projected. The 10 factors we are examining are not speculative risks. They are documented, recurring conditions that appear consistently in transaction data across markets and price bands, and their cumulative effect on long-term liquidity is material. The first factor is proximity to high-tension power transmission lines, which exerts a statistically consistent downward pressure on residential values that has been documented across multiple academic and appraisal industry studies. The mechanism is twofold. The first component is aesthetic. Transmission infrastructure is visually dominant, incompatible with the residential environment, and not subject to removal or remediation by the property owner under any realistic scenario. The second component is perception-based health concern, which, regardless of its scientific resolution, continues to influence buyer behavior in ways that are directly observable in transaction data. Properties within 300 feet of high-voltage transmission corridors sell at discounts ranging from 6 to 18% relative to equivalent homes without that adjacency, and they carry longer days on market figures that reflect the narrowed buyer pool. For lenders and appraisers, the discount is typically acknowledged in the comparable selection process, which means it is formally embedded in the appraised value and therefore in the loan-to-value calculation. Buyers who acquire these properties at what they perceive to be a modest discount frequently discover at resale that the discount is structural and stable. It does not compress over time, and it cannot be engineered away through renovation or capital investment. The second factor is school district boundary positioning, which in American residential real estate operates as one of the most durable and least volatile determinants of relative value. The premium commanded by properties within the attendance boundaries of high-performing public school districts is well established. What receives less analytical attention is the inverse, the discount applied to properties that sit just outside those boundaries, sometimes within a matter of blocks. In competitive suburban markets, the price differential between otherwise equivalent homes on opposite sides of a school district line can range from 8 to 22%. That discount does not respond to neighborhood improvement, infrastructure investment, or general market appreciation in the way that other value factors do. It is a fixed characteristic of the asset, and it systematically excludes a segment of the buyer population, families with school-age children, that represents a significant share of demand in the $700,000 to $2 million price range. Reduced buyer pool means extended time on market, which in a rate-sensitive environment translates directly into pricing concessions at exit. The third factor is flight path and airport noise exposure, which has demonstrated a persistent and measurable impact on residential values in affected corridors that is frequently underestimated by buyers who visit a property during low traffic hours. Aviation activity follows scheduled patterns, and a property that appears quiet during a Tuesday afternoon showing may be subject to significant overhead traffic during morning and evening peak periods on weekdays. The Federal Aviation Administration maintains noise contour mapping for commercial airports, and properties within the 65 DNL contour, the threshold above which noise exposure is considered significant for residential use, face documented valuation discounts, and in some jurisdictions, mandatory disclosure obligations. More consequentially for high-value properties, the shift toward new-generation aircraft with altered approach and departure geometries has extended noise impact zones to corridors that were not previously affected, creating a category of sellers whose properties have experienced noise exposure increases since acquisition, with no corresponding adjustment in their purchase price. The fourth factor is the presence of a property in a FEMA-designated special flood hazard area, specifically zones AE, AO, and VE, which carry mandatory flood insurance requirements as a condition of federally backed mortgage financing. The economic implications are direct and compounding. Mandatory flood insurance through the National Flood Insurance Program adds between $1,500 and $12,000 annually to ownership costs, depending on the property's elevation relative to the base flood elevation, the construction type, and the coverage amount required. FEMA's Risk Rating 2.0 methodology, fully implemented in recent years, introduced actuarially grounded pricing that in many cases dramatically increased premiums relative to the prior rate structure. The buyer pool for flood zone properties is constrained not only by the insurance cost, but by the financing complexity. Some lenders apply additional underwriting scrutiny, and some buyers with prior flood experience are categorically unwilling to consider flood zone acquisitions regardless of price. At resale, that constraint does not diminish. It tends to intensify as flood insurance pricing continues to migrate toward full actuarial cost. The fifth factor is functional floor plan obsolescence, which in the current market represents one of the most reliably value-dilutive property characteristics that cannot be corrected without significant structural investment. Contemporary buyer preferences, validated consistently across buyer survey data and reflected in new construction specifications, prioritize open-concept living configurations, primary bedroom suites with dedicated bathroom and walk-in storage, and dedicated flex space suitable for home office use. Properties built before approximately 1990 in many markets feature compartmentalized room structures, shared bathrooms serving multiple bedrooms, and no architectural provision for remote work. A $1.4 million home with a functionally obsolete floor plan will consistently trade at a discount to a $1.4 million home with a current configuration, and the renovation required to close that gap, involving load-bearing wall modifications, plumbing relocation, and permitting, frequently costs between $180,000 and $350,000, with no guarantee that the improvement will be fully captured in the appraised value. The sixth factor is proximity to commercial or light industrial zoning, with particular attention to uses that generate traffic, noise, odor, or visual disruption during hours that overlap with residential occupancy. Gas stations, auto repair facilities, fast food drive-through operations, and distribution or light manufacturing uses adjacent to residential neighborhoods generate documented price discounts that reflect the direct reduction in residential amenity. The key analytical point for buyers is that zoning adjacent to a residential parcel is not static. A currently vacant commercially zoned parcel that appears benign at the time of acquisition can receive a permitted use that materially diminishes residential value without triggering any legal remedy for the adjacent homeowner. Buyers who do not review the full zoning map, including adjacent parcels, and assess the highest and best use potential of neighboring commercial land, are accepting an unquantified optionality risk that can crystallize at any point during the holding period. The seventh factor is HOA financial distress, which in condominium and planned unit development communities translates directly and immediately into individual unit values. A homeowners association that is carrying deferred maintenance obligations, operating with reserve funding below the thresholds recommended by reserve study professionals, or managing active litigation exposes unit owners to special assessment risk and, critically, to financing obstacles at resale. Fannie Mae and Freddie Mac maintain specific guidelines governing condominium project eligibility, and projects with significant deferred maintenance, inadequate reserves, or active litigation can be placed on restricted or ineligible lists that effectively remove conventional financing as an option for buyers. When conventional financing is unavailable, the buyer pool narrows to cash purchasers and investors, and the clearing price reflects that constraint. A unit in a financially distressed HOA that would otherwise transact at $680,000 may clear at $530,000 to $560,000 in a cash-only market, representing a discount that the unit owner had no direct mechanism to prevent once the association's financial condition deteriorated.
The eighth factor is deferred exterior maintenance visible from the street, which in the context of resale functions as a signal that extends far beyond its literal scope. Peeling paint, deteriorated roofing materials, cracked hardscaping, and unkempt landscaping are not simply aesthetic issues. They are informational signals to buyers and their agents that the property has been managed reactively rather than proactively, and that the likelihood of deferred maintenance extending to less visible systems is elevated. The psychological and financial impact is disproportionate to the actual cost of the visible deficiency. A $12,000 roof repair that has been deferred may cost the seller $40,000 or more in price concession because buyers apply a multiplier to observed neglect that accounts for the unknown cost of what they cannot see. Properties that have been maintained with visible attention to condition consistently demonstrate faster market absorption and stronger price per square foot outcomes than equivalently located properties that have been managed to minimum acceptable standards. The ninth factor is the documented presence of environmental contamination or proximity to contaminated sites listed on state or federal environmental registries. Superfund sites, leaking underground storage tank locations, and properties with documented soil or groundwater contamination carry disclosure obligations in virtually every state, and the financial impact on adjacent and affected properties can be severe and sustained. Buyers frequently discover at the title and disclosure review stage that a property they had identified as attractively priced carries an environmental condition that their lender's underwriting guidelines treat as a disqualifying factor. Even where financing is available, the insurance and liability implications of environmental contamination create a category of buyer reluctance that is difficult to overcome with pricing alone. Properties in proximity to contaminated sites, even where the contamination itself is not on the subject parcel, consistently demonstrate longer days on market figures and steeper price reductions relative to initial list price than the broader market in the same geographic area. The 10th factor is demographic and demand trajectory at the micro-geographic level. Property values are ultimately a function of the demand directed at a specific location over time, and that demand is driven by population growth, income levels, and the preferences of the dominant buyer cohort in each market cycle. Municipalities experiencing net population outflow, declining school enrollment, erosion of retail and service infrastructure, or increasing vacancy in the commercial corridors that support residential quality of life are exhibiting demand signals that, if sustained, will produce price trajectories that diverge negatively from state and national averages. Buyers who acquire in locations with deteriorating demand fundamentals at prices that reflect historical appreciation rates rather than forward-looking demographic analysis are systematically overestimating the resale multiple available to them at exit. The owners and buyers who will navigate the next 10 years of the U.S. housing market with their capital intact will be those who understand that in a low appreciation environment, the factors that quietly erode relative value are not offset by rising tides. They must be identified before acquisition, priced with precision, and either avoided or accepted only at a discount that fully compensates for the structural resale disadvantage they represent. Capital preservation in residential real estate is not a passive outcome. It is the product of analytical discipline applied consistently from the first evaluation through the final disposition.